Good afternoon, traders. Welcome back to Stock Market Movers. I'm excited to get into another show with you guys. Of course, we get into the headlines and, of course, get to the expert opinions to keep you in the informational edge. We have a great day today. 3 guests on the dock today. We got Lloyd, 115. We'll talk about the overall market, what's going on, and we'll dive a little bit deeper into Microsoft's recent moves. At 1:30, we'll get into it, into the bear cave. Yeah, the lights will go red as we talk all about the short report on Planet Fitness. And then at 1:45, we got Howard Klein, founder and partner at RK Equity and the Rock Stock channel, as we get into lithium. Yes, talking about lithium today. Don't miss it, team. A lot to talk about. And of course, some headlines to get into. We'll take a look at what was hot today and what was not, all on Stock Market Movers. 1 hour, 3 interviews, and some headlines. Where else are you guys getting this? Let's get right to the action. There are 3 ways to make a living in this business. Be first, be smarter, or cheat. I can't help you cheat, but I can give you the informational edge to help you succeed in the markets. Welcome to Stock Market Movers. All the market moving headlines and expert opinions every day. They say money is the oxygen of capitalism, and I want to breathe more than any man alive. What's going on, team? It looks like a good day for the Bulls out there as they're definitely taking control. I'm going to twist my camera a little bit here, get myself a little bit centered. But let's get towards the action. Let's take a look at the market. Hold on one second. Let me flip on this. There we go. Got it going here. Sorry about that, guys. I had the book club running yesterday, so I had a different background for the book club. If you guys missed the book club, definitely tune in with the book club. Next Sunday will be our next meeting. Let's get into the action. You guys can see the SPY taking off today, getting back up there towards the 400, through the 400. We're up now towards 401.63 and definitely pushing on the day. We're going to keep watch on the daily to see if we can start closing above the range. That's going to be a good outlook. Right now, it looks great, right? We'll see what happens. Do we get back there towards 410? It's definitely in reach as we definitely are pushing. And a lot of people are starting to bring back the soft landing narrative. A lot of people are starting to think that the Fed is going to pivot sooner or that they're going to slow rates down. I think a lot of people hoping on this trade, but at the same time, what's the price action saying? Price action saying, yeah, we are going higher right now. So I can't blame that at all, and why some people are optimistic, especially as you start seeing the media start focusing on potential soft landing. Of course, this all can get tuned down with the earnings that are coming out later this week. Microsoft earnings going to come. We'll see what happens there. But if for any reason we could climb the wall of worry and get through these earnings reports without taking a major beating or major hit, well, who knows where the market could be in a week or so. This is why you always got to be flexible to your mentality, right? You guys know, like I've said in the past, that I'm going to stay not trying to fight the Fed, right, until they actually pivot. But what are levels, right? Levels are so important. What would get me to the point where we start getting to that bullish tune, right? Well, if we can get above the 410, start holding, getting towards the 420, well, there, definitely, that's when you'll start turning me. Even if we don't have the Fed flipping, we get up there, we're out of this bear zone and starting to climb. We'll see what happens there. Can we get it back there? And of course, what are some of the things that we need to keep watch for? I think it's important definitely to keep watch what happens today. One thing, though, to keep in mind, though, is we are going to have a quiet week from the Fed. Can you guys believe it? Yes, a quiet week from the Fed, as they're not supposed to be speaking this week. They could always come out and give a comment, but last week we got enough of them. So we'll see what happens there in the Fed this week. If they do make a comment or not, I don't expect it. I expect more of the focus on notable earnings like Microsoft, IBM, Visa, MasterCard, Tesla on Wednesday after the close. Don't miss it. Like always, we'll do our best to give you guys those earnings reports right here on Benzinga. Let's keep going. Let's take a look at what kind of stocks we're moving today. I'm going to try to get through some headlines, and then we'll get to our interviews. Once the interview starts, we'll be banging in, banging out. So I'm going to try to do my best to try to get through these headlines really quickly. First one is Spotify, right? Spotify, including the trend that has been shown by others, right? Which is what? Well, it's cut your employees and you get a lift. Well, it seems like that's become a new trend. We'll talk about that with our guest coming up, Lloyd. But Spotify planning to cut 6% of its employees, cutting out the chief content and advertising business officer. So we'll see what happens. This did get the lift. Now pulling back. I thought this would be a little bit stronger move here from the actual intraday action. But you guys can see how Spotify is pulling back there. Let's keep going. There's also of course, different mentions of job cutting, right? How that's affected different companies. We saw how companies like Google and Microsoft have been reacting to news like that. We'll see what happens with these as they are getting a little bit of a pushback. Apple announcing news today, announcing that they will go ahead and target manufacturing 25% of all iPhones in India. I think this definitely gave it a nice lift, got up there towards 142.39 and back above the long-term trend line. That's definitely important for Apple. If Apple's going to start making its run to 150, 160, well, I'll tell you right now, that could definitely get the markets moving. We'll keep watch to see what happens there. And of course, there's different stocks that have been getting uplifts and upgrades and downgrades, but definitely one area that we have been starting to see if the growth names starting to take a lift. Let's go to Wayfair for that stock. As you guys are seeing, Wayfair take a big push up today. Of course, this is coming off of a rating from JP Morgan as they upgraded Wayfair to overweight, raising the price target to 63. What did they know? They know a positive shift in market share trends on what? Management newfound commitment for controlling expenses and investments, something that you guys should continue to watch. They also stated that combined with an earnings revision that they expect after this has been steeply negative for the past 2 years, and they still see this as an attractive valuation, says JP Morgan. We'll see what happens there as Wayfair gets the lift today, got to a high there of 59.36. We'll look to see if we get back up there. All right, getting out of the Wayfair talk, we can keep taking a look at what stocks made news today. We also saw mentions, of course, with OpenAI and Microsoft, right? We've been seeing more and more of this. This got the lift today. We'll talk a little bit more about that investment in, of course, OpenAI, which is the owner of ChatGPT. And we'll see what happens there. Right? Will this continue getting the lift? One thing that I have been seeing, I've been talking about is any mention with AI right now, and it gets pretty sexy. And you guys know when the story is hot, stocks like to move. You guys are seeing Microsoft really start making a move up. Now I'll look to see if we can make a move back towards the 270s. That's where you can get back into the long-term trend line, similar like Apple did, right? Can Microsoft make the move that Apple did where it gets back towards this trend line? We'll see what happens there. If it can make that run, of course, the AI story helping it today. Big level for me will be 250 when we get back up there. Be careful. Highs to the left, 245.75. That's going to be the kind of your first stop. We'll see if we get there and hold. All right, another one that definitely caught the tape was the Salesforce mention with Elliott Management, as Elliott Management takes a multi-billion-dollar stake in Salesforce. Let's see how this kind of traded in the intraday action. You can see it was getting a pop in the pre-market, pulled back towards support. Now trying to just hold over here. We'll see if this actually can get Salesforce moving. It did bounce back, trying to get back there towards the 200-day moving average around 162. We'll see what happens there in Salesforce. All right, let's keep going. We got another headline to get to. There was a upgrade also on another stock that I wanted to keep a close eye, which was Shopify. Let's take a look at Shopify getting a nice little push. We've been talking about this one. You guys know I like it for a longer term investment. I haven't taken my shot in it just because I'm still waiting for the markets to calm down a little bit, but this has been a nice move since the recent pullback. If you take a look here from January 3rd, it's pretty much had a nice push here. It's about 24-25%. We'll see what happens on that Shopify after a Deutsche Bank upgrade on Shopify to buy, raising the price target to $50, talking about how many brands are migrating over from legacy and competing solutions. So we'll keep this on watch. I definitely like Shopify in the long run. The only question is, where do you get it, right? Where does the valuation make sense? That's the question I'd be asking. But we are seeing Shopify get a little bit of a bounce back here. We'll see if it runs into weekly highs. Weekly highs to look for around 45.06, 45 area. We'll look to see if we run into resistance there. All right, that's going to do it for Shopify today. Like always, we can get into some more headlines, but we have our interviews to get to today, and we have 3. So we're going to keep rolling here. Let's get towards our first interview. You guys know he joins us often. I'm excited to have him back on. Lloyd, wealth advisor, investment strategist at Strategic Wealth Partners. Let's get right towards the action. All right, welcome back on, Luke. How we doing? Let's get towards the action right now. And it seems like Wall Street is showing the love right now for companies that are making the cut, right? Some calling it trimming the fat. What do you see in the labor markets, Luke?
Yeah, so there's a lot of fat to be trimmed.
Just give me 1 second, Luke. 1 second. I think you're on the wrong mic here. Let me just adjust, see if I can get it going here. If you could check for me the wheel there on the settings here, I'll put you in the background here so you can just go ahead and try to fix that. Looks like my StreamYard service picked it up wrong there. If you go to the wheel there on audio, we can go to the mic and fix that up right quick here. No worries, Luke. This is on my end because my lovely system likes to change default settings, even though you're probably already set up on that. So the little wheel on mic, I'll bring you back on in a second here to see if we're ready. Let me know when you're ready. I'll give you a little thumbs up. All right, like always, team. All right, ready? Let's go ahead. Let's bring you back, see how the audio is there.
Are we good?
How we doing, Luke?
Can you hear me?
No, I'm still not getting the right mic there. No worries. We'll try for one more second. If not, we can always bring you back a little bit later. If not, we'll do it tomorrow, Luke. We'll figure this out. Like always, team, trying to deal with the background. You guys know it. It's live. We're dealing with it. We'll get to it. Like always, first question that I'm going to talk about is the labor market. Excited to talk about that. And like always, team, we'll see. Cutting the jobs. How's that affecting? I was scratching my head earlier. I put it on Twitter about that. Let's go see how we're doing.
All right, I think we're good now, right?
Boom, baby.
There we go. Rocking and rolling. All right.
Hey,
what I was saying is there's a lot of excess out there, what you're referring to with the labor market question. There's a lot of fat.
Yeah.
I mean, we all kind of puffed up. I put on 20 pounds, right? So we all puffed up. There's a lot of fat out there that does need trimmed in the labor market. And there's this thing going on right now called labor hoarding. That's getting a lot of attention. And it's actually not a new phenomenon. Labor hoarding is when employers hold on to employees because it's very expensive to rehire and retrain workers down the road once we get back into growth mode. This actually happened before in World War II. You know, when all the volatility, all the craziness was happening with the war, after the war, companies were less likely to let go of employees because of the cost of retraining and rehiring workers. So that's one of the reasons why the labor market is so resilient, and unemployment, even though you're seeing a lot of these tech layoffs, it really hasn't trickled down throughout the economy. Now that's concerning though for the stock market, because when the labor market's more resilient, that means that the Federal Reserve has to do more work, right? They have to hike rates. They have to trim the excess in the market to bring down demand, bring down inflation back below the 2% inflation level. So all the people out there saying that inflation's done, we're good to go. Well, the labor market hasn't cracked yet. So The Fed's not going to take their foot off the pedal.
Definitely. And I think that one of the things that you mentioned there that I think is very important is that it's not like we're going in a lot of these companies firing, let's say maybe the low end workers. They're firing some of the high end workers. These are talented
Yep.
individuals, right? That I don't know about you, but if I hear that certain talented individuals are out there, I'm probably going to be wanting to scoop them up if I have any chance of growth in the future.
You're exactly right. The poaching, the great resignation, I mean, both of those things definitely impacted the labor market and employers' minds. But that being said, the past decade, since 2008 and 2009, there has been so much excess out there. You know, these companies, there's managers upon managers upon managers. They're all managing each other. Like, there's no productivity added, right? And when there's no productivity added, that means profit margins get trimmed. That means people get lazy. Companies get lazy with their spending, with their R&D. So what's going to happen is, I think, as we approach 2023, as we come out of 2023, this is actually going to provide an opportunity for these tech companies to get back on track with not being so excessive and adding more dollars to the bottom line, not having managers on managers, right? We can't keep on living in this excess environment. Rates were 0%. People threw money at the wall whenever. That's not going to happen anymore when rates are 5% and the cost of borrowing goes up 5 or 6%, right? So I think this is a good thing coming out of 2023. Just a lot of headwinds still to go over the next year, a lot of trimming to go.
Yeah, definitely. Now, one thing that we have seen for the beginning of the year, it seems like really growth stocks have taken the liking to the January effect, that we've been seeing some of these stocks that were beaten down, really taking the lift. Do you think that this trend can continue, or it might be reverting back to the mean at some point?
I think this is very temporary. Last year's trash is not going to be this year's treasure. Just not magically you come into the new year the first couple of weeks and all of a sudden you can forget everything. That's not the case. You can't do that. Nothing magical changed, the past 2 weeks, right? And what's interesting is the companies that are currently reporting earnings, and we got a lot to go when it comes to earnings over the next couple of weeks. Fourth quarter earnings expectations are already getting lowered like a lot. They were looking to grow 7% this year. Revisions are down to 3% now. And typical recessions, if we get a recession this year, earnings in a recession usually drop by 10 or 20%. So we've got a lot more to go compared to where expectations are and what might actually happen. Both the top and bottom lines are actually both getting revised too. It's not just the top line revenue coming down; it's actually profit margins. But like you said, Mitch, high beta has been outperforming low beta for the past couple of weeks, and that's not going to last. I mean, here's a quick stat. When it comes to the NASDAQ, when it comes to these high beta tech names, the NASDAQ has almost 3 times the debt to equity compared to the S&P 500. Many tech companies are going to have a hard time in 2023 because, like I was referring to earlier, they hired too many people, they had too high of growth expectations, and they took on a lot more debt than they should have. I mean, take a look at some of the stocks that never operated before in like a downturn, in a bad market, in a possibly bad recession. Carvana, 2012. They never operated in recession. Peloton, 2012. Zoom, 2011. Block, 2009. Twilio, 2008. I mean, these companies never operated before. So I would be very cautious when it comes to the high growth tech names that made a lot of money and were the 1,000% winners that tripled, doubled over the past couple of years. I still think they're going to be pretty dead money.
Yeah, I think, one of the things to think about is you're mentioning it, right? A lot of these companies had that zero rate environment, and I don't think they ever thought that this was turning around anytime soon, especially not as fast as things have turned around, right? There's one thing thinking that we might get towards, 1-2%. I mean, the Fed funds, we're talking 5%.
Yeah.
I don't think they were thinking this at any time soon. And especially as borrowing gets more and more expensive, and we get closer and closer to those debt payments as these big companies have looking forward. Yeah, they might play past the buck, but eventually they got to pay, right?
You're exactly right with that. I mean, at the end of the day, too, you got the Federal Reserve fighting the labor market, but they're also fighting the government. I mean, they've been a constant fist fight, the government and the Federal Reserve, with all this inflationary spending, right? I mean, this is the biggest fight of the century that got no airtime on pay-per-view. I mean, this is like Rocky Balboa and the Russian in Rocky IV, right? The government's passes these inflationary spending bills like the omnibus bill, $1.7 trillion. And then look at the tax part of the omnibus bill. Like, 2023 interest expense deductions for businesses are basically gone. Capital expense deductions are basically gone for businesses. R&D expense deductions are basically gone. When companies pay more in taxes, they don't hire as many people. They don't grow as fast. So getting back on track next year is actually going to be even more difficult once we bring down these inflationary pressures because of the getting rid of the deduction expenses, the R&D expenses, things like that, right? And at the same time, the cost of borrowing, these are floating rates like you're referring to. When you're borrowing at 0%, that payment's a lot lower. When you're borrowing and that rate goes up to 5 or 6%, which these floating rates do, that's a big payment in your checkbook that you're not necessarily looking for in the future. That came quickly. That came very quickly because rates rose very quickly.
Yeah, I think it's definitely important to keep in mind how long will they be prolonged? And I think that's the question that a lot of investors are not maybe catching in the Fed talk. One thing they're all
talking about raising rates. Like if they pause there for a year, that's just as bad when it comes to market expectations.
Definitely. And I think there was a specific wording that was not caught by many last week in what changed in the Fed talk. One was every single time I heard it was sustained 2%.
Yeah.
And I think that's an important mention there. It's not just we're getting it back to 2% on inflation. We want to see it stay there. So how long will that take? How many reports will they need?
You are exactly right. It's not like they're going to get down to 2% inflation and all of a sudden everything's good to go. Your lower rates back down to 0% and you fire on all cylinders. That doesn't happen, right? Yeah. What the Federal Reserve and these economists are truly looking at right now and very concerned about, because it's happened many times before in history, is you get inflation back down because the supply chain maybe gets fixed a little bit. That's why we're probably seeing inflation come down a little bit. Demand really hasn't dropped, but you get inflation down and then it rebounds. That's the worst case scenario that would happen in the next couple of years. I mean, if we got inflation down to 2% and then it rebounded, that means the Federal Reserve would basically have to re-hike rates, and the market would not like that at all. So basically, to prevent that, what the Fed's going to do is they are going to pause there longer than I think most people expect to bring down inflation, probably down to 0%, probably not even 2%. They're probably going to drop it down close to negative territory so that we are there, we stay there, and then they might consider pivoting or dropping rates. But I think it's probably going to be at least 1 year before they even talk about a pivot and dropping rates. Yeah. So I think we got to get that out of our lingo. The pivot talk, pausing is going to happen, but the pivot talk, I think the market's really getting ahead of itself there.
Definitely. And I mean, we're seeing it in the recent action. It seems like we're definitely getting some up moves here from the semiconductor chips. The last question will be more towards Microsoft, especially now that they're expanding their partnership with OpenAI and AI in general. What do you think about this situation, Luke?
I think Microsoft's probably one of the best stocks, long term, and out of the big tech names right now. I mean, Amazon's very discretionary. I would not stay away from Amazon, but I would be more cautious on Amazon than other big tech names like Microsoft. But I think Microsoft's positioned itself to be possibly one of the biggest companies possibly the biggest company in the world. And obviously already is one of the biggest companies. I think it's going to be actually the biggest company probably down the road. Apple, I mean, the thing is with iPhones, as we enter into this environment, there's only so much you can do with Apple to make it better, right? Put it on a better camera, like, a couple megapixel camera, cool. If you make it thinner, smaller, do different things, cool. But at the end of the day, when money's tight, which it hasn't been tight for a lot of people for a long time, but when it starts getting tight, you're not looking to buy the newest iPhone, every single year. But Microsoft, when you have cloud businesses, small businesses operating, coming out of this recession, most likely coming out of next year, you have small businesses trying to get back on track. You have businesses becoming more efficient, meaning they get rid of employees, but they get better technology. Microsoft is there to provide that. So I think Microsoft, this GPT, OpenAI is revolutionary, and I think it's a good ad for Microsoft.
We'll see. We'll see if the robots start taking control also. Maybe
I've been watching Terminator, man. I just hope no Skynet situation happens. But artificial intelligence, the scariest part about that is when AI starts programming itself, right? That's going to be the scariest part, and we're close to that.
Yeah, we'll definitely have to keep watch. Microsoft definitely getting the lift. It looks like the semi is also getting a lift today. We'll see what happens. Appreciate you joining me like always, Luke. Lloyd.
Sorry for the audio.
You guys can keep up with them. No worries. It was my system anyways. Have a good one, Luke. Always great to have you. Take care. All right, let's go ahead. We'll get out of that first interview. And I think it's definitely important to keep eye what goes on in that labor market. right? And will they be able to rehire? That's what I'm looking at, because I know rehiring is tough. I've been in situations where I've had to hire a certain amount of employees by an X amount of date, and it doesn't make it easier, right? When you have that pressure, especially if it comes to the point where these companies are going to start seeing growth come back, and then they're going to look left and right and realize they don't have the troops to make that growth move forward. We'll see what happens. All right, let's get out of that interview. We're going to keep going into our next interview in just a minute or two. I do want to take a little peek into the markets. Let's take a look at the rotation on the day, on what was hot and what was not. You guys can clearly see technology making a big leap up. You guys can see here also from my daily sector outlook. This is, of course, unweighted. I like looking at unweighted index to try to find where the relative strength is. Let's go to the high cap names today in kind of, we can do technology overall. Let's do sector here. And you can see Apple having a really nice day back into the 140s. We've talked about that. Microsoft getting the lift. Google, TSM continuing. Also, I think this one's an important one to mention because the Warren news, right? Warren got it here to 83. It's already at 95. Guess don't be fighting Warren much, right? It did do a gap fill, came right back up there. So not a bad outlook there as you're seeing that continue. NVIDIA, nice little takeoff day. AMD pushing back. We'll see what happens. Can this get towards the 200-day moving average around 80.37? It's been a really good day there for technology overall. Consumer cyclical, high beta stocks, right? Auto manufacturers having a good time. Department stores having a good move today. Luxury goods, a lot of these high beta names continuing to get some lift. We'll see what happens there. Industrials able to bounce back today. Cat, Honeywell bouncing back there. Deere getting a little bit of a bounce back. Boeing not having a bad day there. Keep your eyes on Boeing earnings later in the week. We'll see what happens there. And GE, I cut that swing trade, and I'm happy I cut it because it's coming right back towards my entry. We'll see what happens. Was able to make a good profit on GE. Just had to cut it today as it went through 78.50s, and that was from around the 80s. So happy I cut that one. We'll see what happens there in General Electric. And just to kind of state what wasn't hot today, really pretty much everything in the green from the open. Communication services lagging a little bit, healthcare lagging, but honestly, not a bad day overall for the bulls as we're up there towards 401.98, almost to the 402. We hit 402.11 just shortly at 11:30. We'll see if it take it out. All right, getting out of that conversation, let's get into, hold on a second. We need to change something up. It's Bear Cave time. Let's go. Let's get it started. Let's get into the Bear Cave. All right, Edwin, how we doing today? Let's go diving into, or maybe a little lifting into, Planet Fitness. Let's talk about what happened here recently. You guys did release the Bear Cave, a short report on Planet Fitness, and we did see a downturn in the stock recently, still down from that. And of course, let's get into what was in the short report. First, give us a basic review of it, and then we'll dive a little bit deeper into certain parts.
Mitch, absolutely. So I recently wrote a critical article on Planet Fitness in the Bear Cave newsletter. It really focuses on one issue, which are customer cancellations and the company making it very, very, very difficult to cancel Planet Fitness subscriptions, which might cause some long-term problems for the company. For example, it's easy to sign up, but to cancel, you can't do it over phone, you can't do it over email, you can't do it over app, you can't do it over the web. You can only cancel your Planet Fitness subscription by going into the home location where you signed up or sending a letter. That's their policy. And based on consumer complaints I obtained through a bunch of FOIA requests, it doesn't appear like they're following their policy in a lot of cases, or at least their franchisees aren't always following their policy. For example, you'll have consumers who will send one letter in to try to cancel their Planet Fitness billing. it won't stop. They'll send a second letter in. They'll send a third letter in. Then they'll call and say, why haven't you canceled my subscription? And according to these complaints, the manager will say, oh, we have too many cancellation letters. We can't find you. Send a fourth letter. It's really, really, tough when you're looking at these consumer complaints of people who've been spending like tens or hundreds of hours of their life just to try to cancel these Planet Fitness subscriptions, to think this business has a ton of value in the long run. I would say, another issue with Planet Fitness is when you make stuff tough to cancel, consumers typically file credit card disputes. That tends to be the result of a tough cancellation process.
Mm-hmm.
Planet Fitness has circumvented that completely by requiring people to generally sign up with a debit card or direct cash transfers from their checking account. And that has left consumers in a bind a lot of times. Because you're trying to cancel, you can't dispute it. You can't really block payments in an easy way. So Planet Fitness is just going to keep charging you all the way until your bank balance is drained. And there's people who incur hundreds of dollars of overdraft fees from unwanted Planet Fitness memberships. Often it costs money to cancel. So sometimes people will say, I'm too poor to continue paying Planet Fitness, but I'm too poor to cancel my Planet Fitness subscription. There's a lot of issues here that come from this cancellation issue. And, the last thing I'd note, a kind of compounding factor here that makes this worse for Planet Fitness than maybe other gyms, is Planet Fitness is super beginner focused. Planet Fitness does a lot of things to try to cater towards beginners who might go occasionally or not at all, versus consistent lifters who are going to go every day. For example, the highest free weights at Planet Fitness are around 75 pounds. They don't generally have a squat rack or more advanced machinery. And as I highlight in my article, they have bagels and pizza available every month, which you don't find at many gyms.
Well, I won't say this too bad about pizza. You can offer me pizza any day of the week. I still will probably take it, but we won't get on that conversation. First thing I want to definitely dive into, Edwin, is the difference between what maybe might be hard to cancel and fraud, right? I think this is what we're also determining here. And I think that I can tell you, at least from firsthand experience, my experience at Planet Fitness, talked about it on the show on Friday also. And really, I was able to cancel. I originally signed up in Colorado Springs.
Mm-hmm.
And so you're talking, completely different. I was here in Charlotte, North Carolina, trying to cancel a membership that I did over there. And a little part of me was starting to freak out, right? Because when I looked into the policy, it was that I needed to go back all the way to Colorado Springs to cancel or send it a letter. I'm with you. I don't trust letters at all. And I think that all those people that have sent letters, they probably have found out too, that nowadays it's just kind of hard to trust letters unless you're getting it signed for delivery.
Yeah.
How do you really know if it gets delivered, right? We don't know. And we can't hold the USPS accountable because this guy didn't receive my cancellation letter. And so I did go towards physically the operation and was able to cancel. They did have to go through a hassle now. Of course, the guy wanted me to go ahead and call the other store in Colorado Springs to get this special membership ID that they needed to go ahead and cancel. They needed to actually transfer the account to that North Carolina property so that they could go ahead and cancel it. So it's a big hassle, right? That I do agree with. Now, the question is that hard to cancel or is that fraud? What would you think in that case, Edwin? At least in my personal case.
I would put this stuff in two buckets. Where is the process breaking the law? And then are they following their process? The process breaking the law. That's a little more of a gray zone to me. It's okay to add friction sometimes. If you look at what Lena Khan at the FTC is doing, and she has specifically called out Planet Fitness, is her view is, and they regulate all businesses, is that it should be as easy to cancel as it is to sign up. Now, that's not the case for Planet Fitness. And as the FTC starts to enforce that more, or maybe we see regulation by enforcement, I think Planet Fitness and a lot of gyms are going to be the natural target of that. because it's not a just Planet Fitness thing. A lot of gyms make it more difficult to cancel than it is to sign up. Likely because there's so many people who sign up on January 1st and then 6 months in want to cancel, but a little bit of friction prevents them from canceling. Now, to your real question about is it fraud? What I would say is it varies a lot by franchisee. So there's 2,000 plus Planet Fitness locations across the country run by about 130 franchisee groups. So most people operating a Planet Fitness are operating multiple, like 5, 10, 20, something like that. And you'll see, at least in my view, it varies a ton by franchisee. Some will make it a little difficult to cancel, but will still do it, maybe like yours. Other places will come up with every excuse in the book not to cancel. And then it's kind of, to me, fraudulent. If you say you need to go in person to your home location, somebody does that. And what I'll see from the complaints is they'll say, even though I drove an hour out of my way to go there, they still wouldn't cancel because they said today's a processing day and this is a 7-day window when we're processing and we can't cancel on processing days. And of course, they're not having that in their written policies online, and doing so would seem super sus. But you'll still get cases where you can't cancel. Or another one I saw, oftentimes the elderly are the people who are like hurt most with these abusive policies. Is somebody signed up and they used their checking account and they had the debit card as their backup payment. And they ended up closing their checking account, but they still have their debit card on file. So Planet Fitness continued to build the debit card. He'd pay on time with the debit card, but they charged $30 a month in fees just for the fact the primary payment wasn't working. And they were still getting on-time payments from the secondary payment. And it's like, that's crazy. You're like sending a guy in Social Security, like draining his bank account over like a gym membership that's supposed to be just $10 a month and very affordable. Or you'll see people like stop paying, start back up paying, and now they have a huge back balance, so they can't cancel until they've paid off this huge back balance. And people are like going into debt, getting thousands of dollars of overdraft fees from like a simple, supposedly affordable gym membership. So I think this is going to become a big problem in the long run, where if you have 16 million members and a strong amount, maybe even a majority, trying to cancel or unaware they're still being billed. Like I've seen people say in complaints, I had no idea I was being billed for the last 9 years. They never notified me. I just checked my credit card statement. When you have millions and millions of users like that, especially with the leverage embedded in a franchise or a franchisee model, I think as that starts to roll off, as their cancellation policies get more scrutiny, as the laws potentially change in the favor of consumers, you'll see problems. And the last point I'd kind of weed this into that's related is I believe Planet Fitness in a lot of cities is oversaturated. So there's not just 1 or 2 Planet Fitnesses in many locations. There's like 20. I found a lot of examples where a Planet Fitness is literally 1 mile or 2 miles away from another Planet Fitness, which kind of makes no sense to me, especially like, outside extreme urban environments like New York City. To me, it's a sign of oversaturation, which could help the company in the short run because you get more franchisee fees. You might get a little more in royalties. The Planet Fitness sells equipment to franchisees and makes a lot of money that way. So that having a ton of, franchise locations is beneficial in the short run, but if they're too close to each other, then neither one is profitable and they're going to be antagonized with the parent company and maybe both will shut down. So I think it's an oversaturated business with abusive cancellation policies. And I think those issues are really, really big and the market still doesn't fully understand it.
Yeah, I think you're correct on there. I think we can all look around and see how many gyms are in our areas and see probably oversaturation, whether it be from Planet Fitness names to LA Fitness to Crunch Fitness. There's so many fitness out there in gyms right now. And of course, one of the things that Planet Fitness said about the complaints is that looking into consumer-focused businesses, right? And that the differences between kind of the complaints that you're getting with different consumer-focused businesses. Of course, they want to have you look at different ones in that consumer focus so that you can see how the complaints are very similar. Of course, I would say also that most gyms have not made it easy to cancel, right? And I think that this is maybe a unwrapping something that's even bigger, like you've mentioned, that needs to be looked into on how the consumer is being either misled or fraudulent here on hard to cancel, whether it be for different gyms, right? I think in this case, it's a bigger case here that needs to be looked into. And who knows, maybe the Better Business Bureau needs to be doing a little bit more about putting out with these businesses that the complaints exist, right?
Yeah, that's very true. I bet gyms all across the country, especially some mom and pop ones that are struggling, probably like don't process cancellations in the way they should. The thing that's additional about Planet Fitness, though, is it's really the low cost, $10 a month. I'm an everyday American signing up for my New Year's resolution. And, a high proportion, like for most gyms, you have a ton of regulators who go every day, 3 days a week, 2 days a week, whatever. I don't think you see that as much with Planet Fitness. I would guess, based on their marketing and how they brand themselves, it's very much a lot of people going once every 6 months or not going at all who want to cancel. So I would say Planet Fitness's membership base skews heavily towards people who never go and want to cancel, which is why the issue is bigger for them than another gym. And as you know, gyms are like very low barrier to entry. Anybody could start a gym. It's just rent a lot of space, put equipment in, and bam, you got a gym.
I mean, we could see the expansions of like the CrossFit gyms, right? I'm sure everybody's seen a CrossFit gym open up near to them that isn't as big as the other gyms, but still able to get some of the market share. One last question here. And of course, one of the recent things that we've been seeing is companies like Peloton and Netflix expanding into workout. I don't know if you guys in the audience have seen, but yeah, Netflix has a partnership it did with like Nike and put out like 10-minute workouts on Netflix. I even took a look at them just to kind of see what they were offering. Are home offerings like this going to be and hurt the physical gym memberships like a Planet Fitness?
That's a great question. Honest answer, I'm not sure how big of an effect. It's probably going to be a headwind. My guess is this plays out over like 40 or 50 years rather than 5 years. A lot of people were speculating, Peloton and Planet Fitness, one will do well, the other will fail. I think there's always, at least for like the next decade or two, going to be a large number of consumers who can't afford hundreds or thousands of dollars of home workout equipment and want just the cheap, let me go to the gym, let me have a gym membership. So I think for at least the near term, they're going to be okay.
All right. Sounds excellent. I think this is something that we need to keep a watch on, and we'll definitely bring you back, Edwin. The next time you want to uncover the bear cave, you got to let me know.
Absolutely, Rich. I love
turn quick. They turn quick here. I'm all for it. You let me know, Edwin. We'll be here for you, and we'll definitely see what happens next coming out of the bear cave, and to see if Planet Fitness, will they turn things around or will they continue to struggle things here? I think one thing to note, I did cancel for the beginning of the year, and I went to LA Fitness, so I don't know if that says anything. But just to mention that, have a good one, Edwin. We'll bring you back on, and you guys can keep up with Edwin Dorsey or the Bear Cave on Twitter. Give them a follow. Appreciate it, Edwin.
Thank you.
All right, that's going to do it for our second interview today. We're going to keep things rolling, keep the ball moving. All right, let's get out of the Bear Cave, back to the blue action. Let's take a look at what's going on in the markets right quick, and we'll get into our next interview. Just want to take a little peek. Boom! Booyah! We're through 402. We're at 402.37. The Bulls are loving it today. This light's going to soon change the green light soon here, because I know it out there. The Bulls are loving today. The Bears are running. They're running away. We'll see what happens in the market. Will we keep climbing the wall of worry? All right, getting out of this, I do want to get into a great conversation next with Howard Klein. I do want to talk about lithium, team. I've talked about plenty of times, right? The thing behind the thing, right? And I know that we all like to look at thematic trades here on Stock Market Movers. One of the biggest themes, right? What's going to happen in EV, right? And what are the drivers needed to actually get that mass adoption? Questions like this all coming up right now in our interview. Let's get to the action. All right, let's bring on Howard. How we doing today? It's good to have you on for the first time.
Thanks for having me, Mitch. Nice talking to you.
Definitely good to get into some lithium action. Of course, like you heard me mention, I've always called it, like here in Benzinga, we call it the thing behind the thing. When I was in school, they tried to refer to me as the underlining asset, and it was all about lithium here. So let's first start talking about lithium. Why do you feel it's so important, and why should we be kind of keeping an eye on it?
Well, lithium is, the limiting factor for lithium-ion batteries, which are powering electric vehicles and energy storage. So, wind and solar grid storage is an underestimated, application for batteries that use lithium. But electric vehicle dynamic in the last few years, as Tesla has demonstrated that this is not just some small niche that's going away, but is the big thing, is the next big thing, and lithium is definitely the thing behind the thing. And you're hearing Elon Musk talking about it regularly because lithium prices have gone up some 10 times from their bottom 2 years ago, and they remain very high. And as a bottleneck, the supply is lagging this very significant increase in demand. The demand started in China, and under the Biden administration, under the Inflation Reduction Act and the Bipartisan Infrastructure Law, they have really set forth a very significant industrial policy focused on climate, focused on renewables, but within that, the EV support is very, very strong, both from demand subsidies, but also in terms of supply incentives. So it's a very small industry, lithium, but you can't make a lithium ion battery without lithium. And permitting challenges, technical challenges, and all sorts of other challenges in a small industry that's being asked to ramp up very aggressively. And it's an industry that has not historically seen a lot of big investment. In the last few years, you've had big investments in downstream, Rivian and Fisker and QuantumScape, and a lot of money was thrown into the production of vehicles and batteries, but not enough in the supply of the raw materials. And that's why you have this mismatch, what we believe is a structural deficit as far as the eye can see, as long as the next 10 years. And the beneficiaries of those are companies that can get into production and produce at these very high prices, what Elon Musk is calling lithium software margins. He misspeaks in talking about refining as separate from mining. The profits are much more in the mining area, and that's where we're focused, and that's where a company like Pilbara Minerals just produced their quarterly results, and they generated in one quarter, I think, nearly $1 billion in cash flow at something like 85 or 90% EBITDA margins, right? For a mining company, just scooping up, dirt from the ground, concentrating a little bit, and then shipping it to China, you could earn these enormous margins. So that's the thing behind the thing. It's where we've been focusing most of our attention for the past, 5 years, but I've been in lithium as long as 12 years or 14 years,
Excellent.
excuse me.
Yeah, that's great. I think we're talking to the right person. Let's talk, of course, where is the majority of lithium kind of mined?
It's currently mined in Australia. It's also produced in South America from a brine extraction technique. So not actually mining, but solar evaporation ponds. And that takes place in Chile and Argentina. So those three locations account for probably more than 2/3 of the production. And then you have a little bit of production in Canada, some in Africa, some in Europe. But for the most part, the industry today is largely mined in Australia, Chile, Argentina, but processed into chemicals very significantly in China. There's also production in China of low-grade material, in addition to Australia, and South America.
All right, now let's get into it. You just talked a little bit about that and the Inflation Reduction Act and how fiscal policy is truly supporting the lithium industry now. And I think, if anything, it points to more support down the line. Of course, when we're talking about kind of EV credits and we get into more of the materials that need to be made here and kind of specifications in that, what are you seeing that should really give maybe lithium a lift?
Well, I think we're overly reliant on China for too many things. We saw that in COVID, but just from a geopolitical point of view, you can't be overly reliant on one country and a country, if not adversaries, but at least there's geopolitical competition. So over the past 30 years of globalization, we've offshored everything to China, to Asia, and we realize that we can't do that exclusively anymore. So we need to localize supply chains for a host of reasons: geopolitical, environmental sustainability, manufacturing efficiency. It just doesn't make sense to ship large amounts of rocks, or half processed rocks all around the world when the factories are being built now here in America. So the Inflation Reduction Act and the bipartisan infrastructure law, we talk about a battery arms race, right? Similar to the nuclear arms race. So over the past number of years, China has had a policy, made in China 2025. The auto industry is one area, like it's a major industry, major employer in Europe and the United States, but China has designated that as, we can't compete on internal combustion engines, so they're betting, on electric cars. So they've made a lot of investments across the supply chain, and America, has woken up to that, and the bipartisan infrastructure law and the Inflation Reduction Act are meant to be industrial policy, of the United States, a bit of an answer to what's happening in China. So to localize these supply chains requires mining and processing to take place closer to where these factories are being built in the United States. And America is somewhat focused on US supply, but they're also talking a lot about friend shoring. So very friendly countries like Canada, Australia, Mexico, and other partners, if we're not, can complement this, because they confront the same issues. You can't be overly reliant on China. So American policy is structured to achieve that aim. There are EV subsidies which are somewhat tied to where materials are sourced and whether they are sourced in the United States or a country in which we have a free trade agreement. And there are 20 countries where that applies. There's still some debate. There's some countries who have been left off that list that are friendly to us, but not necessarily free trade agreements. So we'll see where that all lands. But the general tenor of where we're going is much greater investment across the supply chain in EV, battery, cathode, recycling, and processing of the raw materials that go into it. But we're at a very early stage. It's underappreciated how much those laws and tax incentives built into those laws are going to be implemented. The IRS is only currently now writing those rules, so the full force of those laws have not yet been felt in the market, and they will be, and that's why we the structural deficit, secular investment thematic, we think that this is very, very strong. Inevitably, there are going to be some pullbacks, and there has been, maybe a 10 or 15% dip on the spot price in the last kind of 2 months for a variety of reasons. Chinese New Year, often there's slowing. Prices have gotten so far ahead of themselves. Subsidies have changed a little bit in China, but every dip we see in lithium equities are opportunities to buy, because we expect there to be higher highs, because we believe lithium prices are going to remain stronger for longer. Not all companies are going to generate 80 to 90% EBITDA margins like Pilbara is achieving, but you will have super normal margins in this industry for this entire decade, in my opinion, meaning, 30, 40, 50%, 60% margins, very attractive businesses. And it's where the bottleneck is. And in some ways, it's an easier business than some of these downstream, which are highly competitive, lower margin. You got to get market acceptance. But all of these batteries, they need lithium. You have to produce it. You need to mine it. You need to produce it. It's not rocket science. It's easier than rocket science. But it's not so easy to get permitted. It's not so easy to raise capital because it's not an industry that most people in America know about. And to the extent that they know about anything in mining, there's a negative predisposition to anything, where you're putting a shovel in the ground, to mine rock, in America. So I appreciate, the opportunity to speak to your audience. There's a great opportunity, I think, to have a renaissance.
Howard. Now, let's maybe start getting into some of the non-China thematic names that you want to go ahead and bring. Let's go take a look at what type of names should we be looking out there. I know that there's a couple of these that I even like, but I'll let you get to it. What do you see out there?
Okay, yeah, I'm happy to talk about names specifically. Always want to make a disclaimer, like we're not a financial advisor, and we do represent, we are in the business to help advise and promote and raise the profile of a number of the names that I'm going to talk about. So they are investments of mine, and in some cases we are retained advisors to them. So, but we've been representing good quality companies over a long period of time, and with that caveat, the no-brainer opportunity, in my opinion, and your audience is, I guess, mostly U.S. So if you're focused on fully properly listed U.S. names, Piedmont Lithium, we think, can triple over the next, 12 to 20 months. It's currently about a $65 stock price. My partner Rodney has done some, some of the parts analysis, thinks it could be as high as 180 or $190. They have a number of projects, the most advanced of which is a joint venture that they have in Quebec, which is going to be starting to produce this half, by June, and start in a similar way that Pilbara, I mentioned, is having 80, 90% margins. Piedmont could be selling into Tesla, is actually a customer of theirs, which they just rejiggered their supply agreement, which is now going to be wholly based on spot pricing of lithium hydroxide. So it's conceivable that Piedmont will be selling to Tesla later this year and into next year at prices, in the $6,000 or $7,000 range, and they're going to be buying that for about $900, right? So they may, make $5,000-$6,000 a ton on tens of thousands, or 50,000, tons or more just to Tesla. And overall, Piedmont could be, ramping up production to 113,000 tons of production, next year, just from that asset. Then they have other assets in Ghana through a joint venture with Atlantic Lithium. That's going to come on stream in 2024. And then they have downstream meaning they're going to convert hard rock spodumene into lithium hydroxide in the United States. The Ghana project is going to supply a plant in Tennessee for 30,000 tons. That plant in Tennessee actually got a grant from the Department of Energy about 2 months ago of $150 million. And finally, their flagship asset, how the company started, but what is now their fourth project is, a North Carolina integrated mine to lithium hydroxide.
North Carolina,
in North Carolina.
I'm in
Tar
North
Heel
Carolina,
State.
That's why. Yeah.
Are you in North Carolina? Okay. So look, that's it's a mining friendly state. It's a it's private land. It's not on federal land. So they're in the permitting process by the state. It's not in the federal, law. So that's a significant shareholding of ours. We've been representing and invested in this company since 10 million market value. It's now $1 billion. But like I said, we think this could be a $3 or $5 billion company in the next kind of couple of years.
Love it.
Also in
And-
lithium, yeah, go ahead.
Yeah, maybe one more. Maybe we'll get to one more, and then we'll wrap it up there.
Yeah, I think the other one I would mention is Critical Elements. They are permitted also in Quebec. They're only about, I don't know, 300 or 400 million market cap, but permitting has been such a significant challenge in many projects. It takes 5 years, 10 years, et cetera. Critical Elements, which has been a project in development for about 10 or 12 years, got fully permitted in November. So they need to fully fund themselves to produce spodumene. They need about $400 million, and they're in advanced talks with a number of strategic parties. But the valuation disconnect, to Piedmont and others, I think this company could be $1 billion. So it's another 2.5% upside. That's, you have it up there. That's listed on the OTC. It's a main board listed in, its main listing is in Canada on the Toronto Stock Exchange.
Excellent. Definitely opportunities out there. And I'm with you that I see a big opportunity down the line that could be longer than even decades, right? If we're really going into EV and we're not going back to those gas guzzlers, there's definitely opportunities out there, right, Howard? I think that's something that we'll definitely be watching. We'll see what happens truly when the EV wave really kicks off. I think we're all kind of looking towards to see when this really is going to kick off. But I'm in agreement, and I think you are, that we first need to figure out this situation, right? We need to figure out where the batteries are even going to be coming from if we're going to have these vehicles, right? And if we have all these legacy manufacturers telling us that they're going to get to this certain production, well, something has to happen, right?
Something has to happen. You started seeing a little bit of it last year. GM signed a small deal with Livent where they provided $200 million of capital for them for an expansion. Ford is writing a $300 million debt check to an Australian company called Liontown. But we think that the legacy auto manufacturers, as well as Tesla, are going to need to be more aggressive and take, like, back in the day in the 20s when Ford bought iron ore mines and rubber plantations to ensure that he had the raw material supply for tires and steel bodies. The same is true here for battery raw materials. So I want to see Tesla, GM writing meaningful equity checks, either for joint ventures or possibly even buying whole mines all the way upstream.
We'll see what happens there if we do get that opportunity or not. And we'll see what happens with the legacy automakers to see if they start making moves in that department. Appreciate you coming on today, Howard, talking about all different areas in lithium, bringing up the fiscal policy, all the different things that we could be looking at. We'll definitely have you back on, Howard. Appreciate you coming on.
Thanks very much, Mitch. Take care.
All right, that's going to do it for us today. Like always, we went a little extra time, so do me the favor, team. Hit the thumbs up. It's 2:05. I hope that you guys enjoyed today's show. We had a great one. Let's peek back into this market that's in full-on ramp mode. We did get up there towards the 402, got up to as high as 402.65. We'll see if we're able to hold on towards the end of the day. Can we just close above 400? I think that's what the Bulls will be watching. Of course, you guys can keep up with all the action and what goes on in the stock market with At the Close. At the Close will be coming to you at 3:30 Eastern. Joel Elconin is back. Don't miss us. At the Close, 3:30. I'll see you guys in a little bit. Hit the thumbs up on the way out if you guys enjoyed today's show.